My name is Heather Metcalf, and I'm a financial advisor here with Oregon Community Credit Union. Today, we're going to be discussing investment basics. And what that entails is going to be going over different types of investments like stocks or bonds, as well as discussing investment allocations. How do we build that portfolio? And risk tolerance. How much risk are we willing to take with the different types of investments we put inside of that portfolio? Let's get started. Okay, first up is stocks. A stock is giving you tiny little bit of ownership inside of a company. Here on the graph below, we're going to see how a stock would perform against bonds and treasury bills. For the purpose of tracking stocks, we're using the S&P 500. Over a 20-year period, starting in 1996 going through 2016, you can see how the stocks would do over time. That is on the purple line. As you can see, the purple line has a lot of volatility. There's ups and downs, but over the long period, we can see great growth, much more than we do see in bonds and treasury bills. That's the thing to keep in mind, is taking on how much we want to see for growth versus how much risk we're willing to take. That's going to be our risk tolerance portion, and how we want to allocate our portfolio with how much we want of stocks and how much we want of bonds or treasury bills or other investment strategies. That's going to be what we talk about in our asset allocation. Great, let's move on. Okay, so let's compare stocks to bonds. Stocks, again, are being a tiny ownership in a company. A bond, it means you're their creditor. They are borrowing money from you. So over that same 20-year period, how would our stocks and our bonds perform? Well, on average, during that 20-year period, stocks performed at a 7.68% return rate, whereas our bonds had a 5.29% return rate. Their best years were for stocks 33% and for bonds 12%. The reason that there's a difference is because the amount of risk that we're taking on when we use a stock versus a bond. And that'll be important when building that asset allocation structure. How much risk do we want to take on when we decide how much of our portfolio will be stocks and how much will be bonds? Okay, so next up we're going to be explaining what is a mutual fund versus an ETF, or an exchange traded fund. Now, stocks and bonds are investment types, and then mutual funds and ETFs are the vehicles that hold them. So here on the chart, you can see kind of some of the comparisons of mutual funds to ETFs. They both work in a way where they hold various levels of stocks or bonds inside of them, depending on how aggressive or how conservative you want them to be. Just depends on exactly what your goals are for the account and what your risk tolerance is. But please take some time to read this chart below to better understand mutual funds and ETFs. Okay, so this chart is going to give us a lot more information when it comes to those ETFs versus mutual funds. ETFs are a newer investment vehicle. They started out in 1993, really when internet trading became available, whereas you can find some mutual funds that are over 100 years old. Just because mutual funds are older doesn't mean that they're better than ETFs. It really depends on what are your end goals of how aggressive or how conservative you're wanting to be and what types of industries or investments you're looking to get. But there are great ways to build instant diversification into your portfolio without having to go and buy 200 different stocks and 200 different bonds all on your own. This will enable you to do it. So please take a minute and read this chart as well. Asset allocation. So what this means is, how are we going to build our portfolio? How many stocks versus how many bonds are we going to put, and what kinds of stocks and what kinds of bonds are we going to use to make sure we have the best portfolio based on our personal needs and goals? Okay, so take a minute here and read this page so that way you have a better understanding what is asset allocation, what's our goals, and what's our objective. Okay, so this chart is going to give us a great idea of asset allocation and diversification. And what that means is it's going to show us different types of investments, different kinds of stocks, and different types of bonds, and how they perform over a long period of time. So that way we get an idea of how we can build a portfolio with what types of investments and what types of industries we want to have to make sure that we're not putting all of our eggs in one basket. And that way we can weather the storm better if we can spread our risk out into different areas. So for example, this chart will show from 2000 through 2019 what were the best and the worst performing positions in the market in that year. So in the early 2000s, we can see from 2000 to 2002, the gray squares, which represent fixed income, which is just bonds, were the best performers, whereas large cap growth like the S&P 500 or other large cap US stocks were doing the worst. Well, in that time, we were experiencing the big tech bubble burst, and the stock market had big drops those years. However, if we look forward into just 2004 through 2006, we can see now bonds are towards the bottom and international stocks are doing the best. As you can see from looking at any of the colors on this chart, whether we're looking at the dark gray for fixed income, where they're at the top some years and at the bottom other years, because when stocks are up, bonds are usually down and vice versa. We can see that how, depending on what type of investment strategy, all large US stocks, international stocks, bonds, they all have their different rises and falls. What we want to focus on are those beautiful purple boxes in the middle. That is what we call a diversified portfolio. That is a portfolio that has a good combination of both stocks and bonds, has US-based stocks, international stocks. It has a well-diversified front. Do you see how throughout all of the years, it's never up in the top two box areas. It's never in the top two columns, so it's never the best, but it's also never in the bottom two. It's never the worst, because you're getting good, sustained, equitable growth over a period of time. You're not taking on too much risk, and we're also not chasing those crazy returns. We're doing it in a slow and steady strategy to make sure you're having the best growth possible. That is a diversified portfolio. And now that we've gone over asset allocation structure, we're going to discuss risk tolerance. As we saw on the previous page, depending on what type of investment strategy you're wanting, how aggressive or how conservative we're going to be can really shape what our portfolio can do. How much risk are we willing to take on? How much are we wanting to chase that growth and expose ourselves to that much bigger losses in the downside market to get that gain? So this is where we're going to take into account what's our age and what's our goal, what's our time frame until we need to use these funds. This is what we'll discuss when trying to get an idea of, once we know what types of investments there are of our stocks and bonds, our mutual funds and ETFs, how we want to allocate those stocks and bonds inside of those different mutual funds and ETFs based off of our personal risk tolerance. Okay, everyone's favorite topic over the last few years, inflation. Now, when we're talking about risk tolerance, the reason that we're talking about inflation is because most people, when they think about the stock market, they just think about market risk, saying if I buy this stock, it could lose its value and I could lose money. However, there's different types of risks that we're taking on every day with our money that we need to think about, like inflation risk or interest rate risk. What that means is if I put $100 in my savings account and I let it grow for the next 20 years, but it's only earning 0.25%, that $100 is not going to stretch as far 20 years from now as it could have today. Just like we know 5 years, 10 years, 20 years ago, gas, groceries, and housing was a lot cheaper than it is right now, thanks to inflation. So what we need to think about is, how do we build a portfolio with diversification where we're taking on mindful thoughts of all kinds of risk, including market risk as well as inflation risk, because we know just parking out all of our money in a savings account or CD is not going to get us financially to our end goals. And that's what we need to talk about when we think of risk tolerance. Now we're going to be taking everything that we've learned in the last few minutes and figuring out how we can apply it to better enrich our own lives. Okay, so we've gone over asset allocation structure. We've gone over investment basics. What's a stock? What's a bond? What's a mutual fund and an ETF? Now we understand diversification and we even understand risk. So now we need to decide, can we afford to wait? And the answer is no. What we need to do now is get an idea of, if we were to set this money into the market, even through all of the ups and downs of a 20-year period, what would that look like? So let's say we take $200,000 and we go through all of the best days over a 20-year period. The return would be an average 8.82%, or would grow that $200,000 to over $528,000. Versus even if they're in for the worst days, all of the down days in the market over a 20-year period, that account would still grow to $399,000, or an average annual rate of return of 6.61%. That's impressive. If you figure the average money market savings account is paying you about 1%, can you really afford to just let the money sit there? And this is one of my favorite quotes by Sir John Templeton. History shows that it's time, not timing, that is key to investment success. So just remember, even with all of the things that are going on in the world where you might feel like this isn't the right time, it is. Make sure that you take advantage of the time. And with everything that we went over today, above all else, I want you to remember to invest in yourself. You need to make sure that you have a good, strong financial foundation. It doesn't matter how old you are or what your socioeconomic background is, everyone needs a good, strong financial plan. Thank you for taking the time to watch this video today. If you have any questions when it comes to your investment strategies or your retirement planning, please don't hesitate to reach out to OCCU and one of our advisors here, and we'd be happy to help you with your future financial planning needs. Thank you so much and have a wonderful day.